Pretty wild day of trading again. We've just been seeing these really wild price swings in the market. And this really has to do with the negative gamma environment we're in. And for those of you that aren't familiar with negative gamma, this is all goes into the options market. And so in the options market, gamma is a second derivative order. It's a derivative of delta. Delta measures the rate of change of the price. And so again, what we're looking at here is basically the gamma levels, which can offer significant levels of support and resistance. And when there's more negative gamma, it basically means that the market is going to go with the direction of stocks. And so if the stock market's going up in a negative gamma regime, market makers are going to be hedging and buying the market. When the market's going down, market makers are going to be hedging by shorting the market. And right now, we're clearly in a negative gamma regime. This covers all the strike prices. And basically what you can see here is there's very little positive gamma built up. And the flip zone is somewhere in this 59.50 region, it looks like, at least based off of where yesterday's closing interest. You can see about negative 68 billion per 1% move needs to be sold. Again, this is when you look at the puts and calls. This is from optioncharts.io. And basically what this is telling us is that this is creating a lot of these really big and violent moves in the market. For example, today we were up nearly 50 or 60 basis points to start. Then we were down over 100 basis points, and then we were up 70. This is negative gamma regime. On top of that, we went into today's day with a very high level of implied volatility. When you look at it on an hourly chart, you can see yesterday implied volatility ramped all the way up to 31 on the VIX one day, and that was ahead of this big job report. And you'll see this is one of the highest levels we've had now, really going back to since this index has been getting kept accounted for. I mean, there was a lot of high volatility in 22 and 23, but in more recent times, not very often we see this. This was August 5th. This was around the election, November 5th. And then, of course, this was December 18th following that Fed meeting where the market sold off. And so now here we are now. That implied volatility went up a lot. Today it came down. That's what really caused the implied volatility crush we got at the start of the day. For anyone that read my blog last night, I had mentioned that no matter what the jobs data was, it was likely we were going to see some type of rally to start the day. And that's pretty much what we saw. And then once we got that implied volatility reset, trading kind of resumed and took over as it normally would. And, right now what we're kind of just, again, experiencing, at least on the surface, is negative gamma, and that has a lot to do with it. But there's a lot more going on in this market than just options and implied volatility. There's also a currency component to it, and I'm not going to get into all the details here because some of it is a little bit more advanced, but I wanted to just go over it really quickly so everyone at least has an idea of something to watch next week. And what's very clear is that right now we have two things going on. We have very big movements taking place in the euro, and we have very big movements taking place in the yen. And what we've been seeing is a very big strengthening in the euro over the last couple of days, and this is obviously due to the geopolitical things going on in Europe, specifically Germany spending a lot more money on its defense and budget. And so Germany's interest rate has really gone up dramatically over the last couple of days. And this has led to the spread between the U.S. 10-year and the German 10-year, basically. And the collapse in this spread has led to a massive move in the euro. And so it's not really surprising to me to see that we're seeing the S&P 500 really get kind of clocked here as the euro strengthens materially. Yes, some of this started before the euro moved, but you can certainly see that the another major leg started as soon as the euro really started to strengthen in a material way. And the other piece, obviously, being the Japanese yen. We've talked about the yen carry trade in the past. The yen carry trade is clearly at play here as well. Again, you can see how some of the more recent movement in the S&P has been coinciding with the strengthening of the yen. And when you go a little bit closer, here's a 5-minute chart. If we flip this over from the cash market to the futures market, I mean, you can clearly see that the S&P 500 has been trading with the yen pretty much now since the beginning of March, and here it is on an hourly chart again. It's really a very, very tight relationship that seems to have started somewhere around the end of February, and really you can go back and make a case it started before that. And this has to do with the fact that you're seeing the 10-year in Japan really move up rapidly as well. In fact, it's now over the 1.5% mark, and we've seen a very, very big move there. And you can see historically where we are. And if you look at the Japanese 30-year, it's up even more, up to 250. And when you look at the spread between the U.S. and the Japanese 10-year, that's leading to a major breakdown. And so the reason why we partially got a little bit of a bounce later in the day today was because, number one, Powell spoke, and that allowed implied volatility to come down. If you notice, this was right around 12:30. Powell starts talking. The news starts hitting the tape market. Implied volatility comes down. The S&P 500 rallies. Also around that time, we got 10-year rates moving up. This allowed the Japanese yen to weaken a little bit. That led to the rally we got towards the end of the day, and really tells you a lot about what's really driving this market. You have implied volatility very high. You're in a negative gamma regime, and we have what looks like, another unwind of a carry trade going on. But I think this time it's in two fronts. I think you have it in the yen, and I think you also have it in the euro taking place. And if you invert the euro, you'll see that this relationship is also seems to be working with the S&P 500 as well. And this all really has to do with just the dollar weakening, and I think more importantly, money leaving the U.S. and going back home. Please remember to subscribe to this channel, like this video, share it with your friends, and please remember to check out my membership area as well here on YouTube. Have a good one. Bye.